Welcome to The Tax Factor, the top 20 business and investment podcast from Blick Rothenberg, the tax, accounting and business advisory firm. This week with Matt Crawford and Rob Goodley.
I'm Matt Crawford.
And I'm Rob Goodley.
And welcome to The Tax Factor, the top 20 business and investment podcast, which brings you all the latest that's happening in the thrilling world of tax. This week, I'm joined by my colleague Rob Goodley, who'll be talking us through how the well-known MOT provider Kwik Fit managed to get themselves into a bit of trouble with their application of the loan relationship rules and the unallowable purpose tests, and giving his views on the ongoing saga with former Chancellor Nadim Zahawi's taxes.
Thanks, Matt. It's great to be here with you again, celebrating the Big 4-0.
I didn't know it was your birthday, Rob. You don't look a day over 25.
Very cheeky, Matt. But actually, what I'm referring to here is the 40th episode of The Tax Factor, which we've worked out is over 8 hours of tax updates. I was hoping the production team had splashed out on cake, but no such luck.
So first, we're going to discuss the increasing trends for parents to pay their independent school fees early. Rob, can you explain to our listeners why all of a sudden parents seem so keen to pay up to 5 years in advance?
Yes, Matt. As we've mentioned plenty of times now on The Tax Factor, one of the Labour Party's key sort of flagship policies, if you like, is to charge the standard rate of VAT on private school fees, which are currently exempt from VAT. So given the potentially huge impact this will have for parents of children at fee-paying schools, all things being equal, increasing their costs by 20%, it's unsurprising that so many people are looking for ways to plan around this change. One of the approaches that is doing the rounds is incredibly simple. Pay the school fees in advance of a potential Labour government, and therefore any change in legislation. The idea instinctively feels pretty sound when you consider the basic VAT principle that VAT becomes payable at the earlier of the point at which a service is supplied or the point at which the payment is made. By paying now for fees, which would otherwise be due in 2, 3 or 4 years' time, say, the school only needs to apply the VAT laws at today's date and so can therefore legitimately argue that no VAT is payable. However, as ever with tax, things here are not as straightforward as they first seem. Firstly, there's a legitimate question here around this so-called taxing point for VAT purposes. It could be argued, for example, that parents are actually paying a deposit against future fees rather than paying them all up front now. That would move the VAT taxing point to the, if you like, the true supply date, which might be the beginning of the relevant academic year or maybe the start of each school term. That obviously defeats the purpose here because that would then be when VAT is applicable, so VAT would be due on the fees. We also, I don't think, should lose sight of the fact that what we're really talking about here is a form of VAT avoidance scheme, albeit one that's seeking to defeat a proposed change rather than an actual announced one, if you like. Now, there are some precedents in case law, albeit imperfect, that HMRC could look to apply here to say, well, look, this is an avoidance scheme and so it doesn't work. Obviously, if HMRC went down that route, that could create a huge headache for parents and schools. I mean, you could have circumstances where a school is asking for an additional 20% of the fees, perhaps many years later, because it will take time for the inquiries to be raised and things to go through the courts. Now, obviously, this is a very hot topic, if you like, and there's a myriad of non-tax considerations here, which may also feed into this point of risk. Things like what happens if the parents move area when they're in this period in which they've paid for fees, or perhaps their child is expelled. Are fees refunded? What if the school fee rates increase significantly in the future? Will the parents be required to make top-up payments? Presumably they would be VAT-able because that will be when the new rules are in place. So, as well as this tax risk that the thing people need to be aware of, there's all these kind of non-tax things which people should be thinking about before they part with what will be a significant amount of cash. And before we finish on this topic, Matt, something you mentioned earlier to me, we shouldn't lose sight of the fact that governments can, if they wish, make retrospective tax changes. What do you think are the dangers here in terms of retrospective legislation, which could end up meaning that VAT becomes payable anyway?
Yeah, so there's a few ways that I think it could be done, Rob. The first obvious way would be if a Labour government did get into power, they may well hold some form of fiscal event quite quickly after getting into office, and they could make an announcement at that point that from then, even if the rules don't apply from, say, that point and were meant to apply from the 6th of April, that there were anti-forestalling provisions, just like we used to see in other areas of tax, such as disguised remuneration, for example. The more controversial thing that they could do, however, is they could bring in legislation that actually changes the time of supply rules such that the point that you were raising earlier becomes absolutely certain and it definitely doesn't work. So whilst you get certainty on the position, you get all of these people who thought they were paying in advance and therefore avoiding the VAT, and that absolutely wouldn't work. Now, there could be some challenges to that, possibly. Some people say that there are human rights law issues around retrospective legislative legislation, but I've never seen any of those be particularly impressive in terms of success in court. But talking of controversy, Rob, I understand you've been looking at Nadim Zahawi's taxes.
Yeah, that's right, Matt. So this week, the former Chancellor discussed in an on-the-record interview for the first time his settlement with HMRC in relation to, quote-unquote, his shares in a market analysis company that he co-founded, YouGov. So this was big news in 2022, 2023, but it's now, if you like, come back to the fore because he's seen fit to have his first on-the-record interview. And since he's put himself back in the news cycle, I feel like we can't let it go and we have to comment on it because I think it's a big thing for our democracy, I would say. He revealed, as was always suspected, that he'd paid a settlement of just under $5 million to HMRC. And it's been speculated by a number of sources that this included a penalty which was in excess of £1 million. He was explicit, again, that HMRC found out that he had been careless, which is no doubt a specific reference to the likely negotiations he would have had with HMRC at the time regarding the penalty that should be chargeable. Of course, unless he gives more details, we'll never be certain of the full facts. But interestingly, the numbers suggest that either he was charged a penalty at the top end of the possible spectrum for careless behaviour, 30% potential lost revenue, or, which I think is probably more likely, he was charged at the midpoint of the enhanced penalty regime for offshore non-compliance matters.
Rob, you're a man who rather enjoys looking at tax issues around shares given to entrepreneurs and executives. What would be your betting on the kind of mistake that Mr. Zahawi probably made to lead to this issue?
Yeah, I think we'll only ever be able to speculate here, Matt, of course, but I think it's probably worth taking a step back for the uninitiated. Where a tax return has an inaccuracy in it, the penalties that HMRC can charge are calculated as a percentage of the tax revenue that was potentially lost, with the penalty range being determined by reference to the taxpayer's behaviour. Careless errors carry the lowest penalties, followed by errors which are deliberate but not concealed, and then finally errors that are deliberate and concealed. The penalty ranges are then doubled where the error relates to something that took place outside of the UK. So here, Mr. Zahawi is telling us that he was subject to the lowest possible range of penalties. This, to me, looks like an offshore matter as it concerns shares held by a Guernsey company, with the shares of the Guernsey company being held by an offshore trust. On that basis, the settlement reached would suggest that not only was his behaviour deemed to be careless rather than deliberate, which feels generous to me, given he seemingly filed his return on the basis that he had no beneficial ownership in a business that he co-founded, but also that the midpoint of possible penalties was applied. I'll be honest, Matt, that all feels a bit uncomfortable to me, and I would really love to have been a fly on the wall at HMRC when that was agreed.
Yeah, absolutely. And it actually also reminds me of something I read this week on Dan Needle's website, the Tax Policy Associates website. Really worth a read if you've got some time, because it also talks about the efforts that Nadim Zahawi went to keep his name out of the public domain on this issue. And also on the same website, there's actually also a discussion around more broadly the principles of keeping people secret or anonymous when they are filing appeals in the tax tribunal. And I actually take a slightly different approach to the author on this particular one. There's actually a particular case where we don't know who the taxpayer is, but they must be somebody we presume relatively high profile. They've been in some form of mass marketed avoidance scheme, and they've managed to successfully convince the tribunal that they can have their appeal heard completely in private. Now, that's been challenged by not only Tax Policy Associates, but also a number of journalists as well, and HMRC. So it'll be really interesting to see where that comes out in the fullness of time. But Dan Needle makes a really good point that he says that actually making these cases public, you stop people who maybe have a 5% chance of winning a case, taking the case on simply because there's a good expected return for them, because there's a good expected value, because the tax at stake might be so high. A very reasonable point, but I do think it's a slightly more balanced argument than that, because I know a whole load of people who probably know that they would have won at tribunal had they have gone ahead, but simply didn't do so because they didn't want some of their commercial interests disclosed in court, even though they knew that HMRC were probably wrong. So I take a slightly more nuanced position on it than Dan Needle does. So talking of some of these more controversial points, we've had another case as well, this one very much public. Kwik Fit, Rob, what's been happening there?
Yeah, thanks, Matt. So this is a case which was appealed by Kwik Fit first to the first tier tribunal, then the upper tier tribunal. both times resulting in wins for HMRC. The case has now been looked at a third time, this time by the Court of Appeal, who again agreed with HMRC. This is another unallowable purpose case, which I actually talked about the last time I was on the Tax Factor, that time in relation to BlackRock. So unbelievably, as a shareholder tax person, I'm talking about corporation tax again. So as a reminder to the listeners, the unallowable purpose, this is all around interest deductions. So are they allowed or not? And there's this unallowable purpose rule. So to summarize, basically in 2013, Kwik Fit undertook a reorganization, which gave rise to some new intragroup loan balances and increased the interest expense on some existing loans. The key element from the point of view of the appeal was that after the reorganization, one of their group companies, which incidentally had lots of carried forward losses from loan relationships, so this is financing activities, that company was in receipt of several receivables which were now generating lots of interest income. So the net result is that this income arising in that company wouldn't be taxable because it would simply eat away those brought forward losses, which were otherwise quite difficult to access. On the flip side, the deductions arising from those new loan relationships would be deductible in current years against trading profits. So it was creating real corporation tax savings for the Kwik Fit group. Now, the Court of Appeal found that the taxpayers were all well aware of the position across the whole group, knew that interest expenses would arise, and the purpose of the reorganisation was to use those expenses to improve the tax position of the entire group. The relevance of the losses was that the debits, the interest expenses could be generated while the losses in this particular company would shelter the corresponding income. Now, the counsel for the taxpayer tried their best to try and draw a distinction between the use of the losses and the knowledge of the tax deduction, but that was found to be, an unreal distinction by the Court of Appeal, which I completely agree with. The generation of the deductions for the benefit of the taxpayers without tax on the corresponding income was the main purpose of the reorganisation. The Court of Appeal said had been correct in determining the main purpose of the taxpayers had been to obtain a tax advantage, and as such, the increase in the loan interest payments across the group had an unallowable purpose. Finally, leveraging the findings of the BlackRock case that I talked about previously, the court was happy that achieving that tax advantage was the only real motivating factor here, so there should be a 100% disallowance rather than some kind of apportionment. So having read BlackRock a few weeks ago, absolutely no surprises here. The taxpayer here, if they had been a bit further behind BlackRock in terms of timings, probably wouldn't have appealed again, because I think the BlackRock case made this a bit of an inevitability. But yeah, I think again, it's now two cases at the Court of Appeal, which I think have made the playing field quite clear for advisors and taxpayers, albeit is a subjective area.
Yes, Rob, I think actually it seems like very much a continuation of the Ramsey principle, but kind of applied on a group-wide basis. If one looks realistically at the transactions, it was all done to create a specific tax-advantaged outcome. And if we look at that word that the Court of Appeal used, it was found to be unreal. It's very much, harking back to the good old days that we remember from the disguised remuneration cases and Ramsey, that you have to look at what did the group know as a whole. So it seems like that principle very much being extended. Unfortunately, that's all we've got time for today. Thanks very much, Rob, for joining me this week.
And thanks to you, Matt. If you enjoyed The Tax Factor, try our sister podcast series, Brave Business, hosted by journalist and broadcaster Declan Curry. The latest episode has just been released and looks at the topic of the gender pay gap, pay equality, and pay transparency. Joining Declan are Blick Rothenberg's reward services partner, Stuart Hyland, and Azet's Group Chief People Officer, Claire Jepras. You can find it on the Blick Rothenberg website or wherever you find The Tax Factor. Next week, our CEO Nimesh Shah and Roger Holman are back looking at the latest tax stories and news.
I'm Matt Crawford. Thanks for listening and goodbye.
That's The Tax Factor. We'd like to thank you for making us one of the UK's top 20 podcasts. Find all our previous episodes wherever you get your podcasts. And join us again next time on The Tax Factor.